Okay, the medieval bankers, we're talking about banking regulation, and the medieval bankers increased their profits, and today bankers increase their profits by lending money to depositors, lending out money deposited with them by borrowers, with them to borrowers, I'm sorry. Medieval bankers increasing their profits by lending out money deposited with them to borrowers. They had to be careful to have enough money on reserve, that is, in the vault, to satisfy the depositors if the depositors came and demanded that their money, they had to be able to produce it. The depositors must continue to believe there was money readily available, or there would be a run on the bank. You've seen a run on a bank, right? If you saw Mary Poppins, or you saw It's a Wonderful Life, movies that have been seen by millions of people. And basically a run on a bank is when everybody goes to the bank and demands their money. And since the bank has lent out the money to others, that could create a problem. And so there's various ways of dealing with that, which we're going to talk about. Anyway, so by lending money, banks would increase commercial activity, causing a boom. So it was generally true that countries that had established and working bank system were generally prosperous. And actually, though, these industrial nations that created them were also subject to boom and bust, and so that became a problem that we needed to resolve. Anyway, bank runs. The bank that keeps only a fraction of the money on the depositors' money on hand are at risk if depositors lose confidence. So it's not a problem as long as not too many people show up to demand their money. But a run on a bank, people are standing in line, and other people see them and they join the line because they become worried about the bank running out. We're talking about a time at which there was no deposit insurance. That was created in 1933 by FDR when he took office to relieve the banking runs that were going on as Hoover left office, and which he inherited from Hoover, and that worked. So, but there was no federal deposit insurance before Roosevelt instituted that. So it was one of the better things that he did to help with the financial crisis. It didn't resolve the financial crisis. There were other causes, but that was a byproduct of the main problem. Anyway, bank runs. So they only keep one bank's failure often led to a series of runs. So if your neighbor's bank ran out of money and he didn't get all his money, or you knew people who didn't get their money, you would get worried and you'd run down to get your money out of your bank before others did. And so to avoid panics, bankers often set up cooperative networks and lent to one another. That's okay, but what if everybody gets a run on a bank? Where's all the money going to come from? And so that was not maybe the best solution. It was a solution which would work sometimes, but not always. To avoid panics, bankers often set up these cooperative networks, but it didn't really always work. This self-regulating mechanism, self-regulating by the banks, all too often failed to avoid crashing. There was cheating by some banks who didn't keep the amount on hand that they were supposed to, and frankly, sometimes the runs were just too numerous. And so what was done was central banks were created. So England had a central bank. It's called the Bank of England, and it acts as a lender of last resort. And it never runs out of money because since it represents the government, it can print up more money if it need be. So it can always do that. That's not, however, that's one solution to the problem, to have a central bank which will act as a lender of last resort. This was the early solution that was available to prevent bank runs back during the Great Depression. But Hoover, the Federal Reserve Bank, which had been set up in 1913 after the 1807 panic, failed really to prevent these bank runs, failed really to stimulate the economy. It should have been lowering the interest rate. So Ben Bernanke, who had studied the Great Depression, felt that, and many people felt that the Federal Reserve had failed in its duty, and that it could have done more and possibly avoided the Great Depression. As it was, the economy in 1829 crashed and didn't recover until 1953. That is, the stocks didn't reach the same level, the prices of stocks did not reach the same levels until 1953. So if you had been invested, you would have had to wait all that time to have your money recouped by holding the stock, if you weren't able to sell it before it dipped. And most people were not able to sell it and won't be able to sell in that kind of a panic. To avoid panics, bankers often set up these covenants. Okay, so central banks acted as a lender of last resort. Functions of central bank. The central banks served a number of financial purposes which were very helpful to governments that set them up. That's why Hamilton wanted us to have a central bank. He, however, was opposed largely by the southern planters who worried that their plantations might be repossessed by banks, which had happened to some planters. Agriculture was, in some ways, not a stable kind of business to be in. Sometimes the crops would fail out of not because the planter had done anything wrong, but because of weather or other factors. And so it had its instabilities. And even with slaves, you still had to deal with the weather. Okay, so functions of the central bank. Implementing monetary policy. Monetary policy is about setting the rates and keeping track of how much money is in circulation. And you don't want too much money in circulation because it will lead to inflation. And yet you do want enough money in circulation to allow people to start businesses. And in a modern economy, we count on consumers buying goods to create demand. And so you have to keep the interest rate at certain levels to avoid deflation and to avoid inflation. Deflation is worse because that's what you have after a crash, when nobody's working, and money is being held by people because it's becoming more valuable, so people are not willing to spend. It's not necessarily a good thing for an economy. Okay, so their function, implementing monetary policy, thereby influencing interest rates, so they can, if they lower the interest rates, that will increase demand. That may lead to businesses starting and to consumers buying more. Okay, so, tracking and managing the nation's money supply. So that's keeping track of how much money is out in circulation. Acting as a lender of last resort for the nation's banks. Issuer of government debt securities, they do that. And managing foreign exchange and government reserves. Supervision and regulation of the banks. That's basically what the functions of a central bank are classically. We'll see that our Federal Reserve Bank has other functions assigned to it as we go along here. So, Central Bank of the U.S. The Bank of North America was established in 1782 and 1791. It was intended as a central bank but rejected by the states. The First Bank of America was established in 1791, 1811, and it was modeled on the Bank of England, but issued only 20% of the money supply. Second Bank, established in 1813. It was to regulate public credit and establish a sound and stable national currency, liquidated in 1841. These banks were largely inspired by Hamilton, who set up and managed the bank very well and managed to pay off the war debt. The Revolutionary War debt was paid by the central government, not by the states. The states failed to pay those debts, which largely they had signed for, but it was the federal government that actually paid it through its central bank. That was not the Federal Reserve at that time. It was called the Bank of the United States. So we had the Bank of North America and the Bank of the United States. And that was eventually, the Bank of the United States was ended by Andrew Jackson, who was very much supported by the Southern planters, and didn't believe in these banks and thought they were corrupt, as did actually Jefferson. Was convinced that Hamilton's bank was corrupt, and so he had it audited. And you know, after it was audited, they said, no, there's nothing wrong with the way he's running his bank. It's totally legit. And so that was part of the friction between Jefferson and Hamilton. So the Federal Reserve System was later established in 1913. So we benefited, in the early republic, benefited by establishing industries through its bank. So we got a jump on industrialization through the bank that we had until it was closed by Jackson. The Southerners were always unhappy that the North had all these manufacturers and felt that it was drawing attention away from them, that, you know, that the North may become more powerful and that they would lose that power that they had to create the president, largely created by the clause that gave them votes for the slaves that they held, who didn't vote. Slaves didn't vote, but they were counted as 2/3 of a person, which thereby increased the electoral college votes of the South and the senators of the South, so that they were disproportionately empowered by the Constitution. Okay, so the Federal Reserve System, established in 1913, was to act as a reserve and lender of last resort. Like I said, this was created because in 1907 there was a huge crash, which it could have turned out to be worse. There was runs on banks, and J.P. Morgan called all the bankers in New York together, all the big bankers of New York, and got them to agree to stabilize the economy by buying up the shares of those banks that had gone bust, and thereby infusing cash into them and restoring confidence. And it worked. But he did it by locking them in the bank. This is called false imprisonment. Okay, but nobody took him on because he was so powerful in the banking industry that he got away with doing that. But people thought we ought to have some sort of system, maybe like England had, to avoid these difficulties. So the Federal Reserve, established in 1913, was to act as a reserve and lender of last resort. So if you were running out of bank, if there was a run on your bank, you could contact the Fed, the local Fed, the regional Fed in your area, and they would send you as quickly as possible money so that you wouldn't have to close the bank, hopefully, or you could reopen it fairly quickly so as to prevent people from becoming scared and running on other banks. And that could work, and had worked for England. It was subordinated to the executive branch until 1951. So after 1951, it became more independent. Okay. The 1970 goals established and made responsibility for regulation of consumer credit and supervise banking institutions. So this is also part of the new Dodd-Frank Act that has renewed interest in doing these things. So the responsibility of the Federal Reserve have increased, even to where they are to consider the employment situation, which I guess makes some sense that they do that. So we go beyond the classical kind of position of it. So the Federal Reserve Board was created in 1913 by the Glass-Owen bill over opposition of the so-called money trust. J.P. Morgan opposed the creation of the Federal Reserve Board, believe it or not. So the chief purpose of a central bank is, he felt that the bankers themselves could handle it. He believed in self-regulation and that they would handle it. And he said we handled it in 1907, which he did. But, you know, the Congress of the United States felt that this was maybe not as good as having a central bank like England did have. Chief purpose of a central bank is creation of confidence in the banks. To maintain that confidence, the central bank must be independent of partisan controls. Okay, 1970 amendment requires the board to promote employment, stable prices, and to moderate long-term interest. General duties of the Fed: conducting the nation's monetary policy to further goals of maximum employment, stable prices, and moderate long-term interest rates. And so it's a very delicate balancing act. Nowadays they use a formula called the Taylor formula to set the interest rates, so we'll talk about that in a bit. It also has the job of supervising and regulating the banking institution. That is, it goes in to inspect the banks and make sure that they've got their reserves right and that their capitalization is right, that there's nothing funny going on, that their investments are sound and that the banks are being run soundly. Nowadays, there are additional things that are brought in by Dodd-Frank that relate to this supervision and what they can do, and we'll talk maybe a little about that, maybe not today, but maybe in a future lecture. Anyway, maintaining stability of the financial system and containing systemic risk arising from financial markets. So there is systemic risk in our system, and this is historically why there were so much booms and busts, as we will see. And it is also to provide financial services to depository institutions. What are depository institutions? Those are the banks that you deal with. These are also called commercial banks. So the banks that you probably have a banking account and put a deposit in there for a checking account, or maybe even a savings account, or maybe you have CDs. These are depository banks, also so-called commercial banks. And so it supervises those and makes sure that they're running soundly. It also supervises the investment banks. And also it provides financial services to the government and foreign official institutions. Not so much. It doesn't provide as much services to the investment banks that are thought to be able to take care of themselves. But there are some restrictions on them. Monetary policy. The Federal Reserve is charged with controlling inflation, deflation, and promoting employment. So the what it does, what the Fed does, is its committee votes and sets inflation targets achieved by adjusting the interbank interest rate through its open market operations. So it sets a rate for its intermarket operations, and those affect the rates that the banks will charge you and business customers who come in, small businesses that come in and maybe want to get a business loan, or a person wants to start a business and you may go to a bank and get a loan that way. So that's what these depository banks do, these commercial banks do. Anyway, the Taylor rule nowadays is a method of determining the interest rate target. So that takes into account various indices, various measures of the economy. And, basically they have a mathematical formula that suggests what they should set the rate at. And we'll see how surprisingly it's been used. Okay, so this, I have a chart here, and then I'll explain to you what it is, and you'll get this chart with the PowerPoint. U.S. financial crises and stability. So it shows all of the crises that happened. So 1792, 1796, 1797, 1857, 1873, 1893, 1907. These were major recessions. There were other recessions that were not as bad, but these were major recessions. Looking there about every, maybe on average, maybe every 20 years, it seems that there was a major recession. And these were hard times for people. And there was no, there was no central bank for most of that. After Jackson closed the banks, there was no central bank. And so banks, oftentimes there were bank runs, and a lot of banks would go out of business. And so, after 1907, they passed the Stiegel Act. I'm sorry, they passed the Federal Reserve Act, and in 1929 we had a Great Depression. And Bernanke, in his analysis, says that the Federal Reserve screwed up. They should have lowered the interest rates, and that would have helped with the depression. And that's what they didn't do. You know, they should have increased lending, made lending more available. And that's a way of stimulating demand, isn't it? Other countries who had done that did better, and the countries that did the best were the ones that adopted a fiscal policy, putting hands out there, you know, usually doing some sort of government works that would employ people, and thereby getting people money in the hands of people so that they could demand things. So this is called nowadays Keynesian economics. I'm told that there was a Japanese finance minister who did exactly that, and he came out of the, he was early into the, they were early into the depression because of their circumstances, but they came out of it very quickly. And Hitler, when he came into office, he started rebuilding his army, which he wasn't supposed to be doing, and that helped bring back the German economy. Sweden had actually done a very similar thing, not with army, but with other kinds of works that it started, and it had great success in that. So Keynes's ideal actually had some precedence. And some of these, like Hitler's, he may have been following Keynes' ideal, because he was an admirer of Keynes's work, because of Keynes. After World War I, Keynes was at the conference where they imposed the reparations, forcing Germany to repay debts of Italy and France and England because they had started the war. And you know, Keynes had stated to them at that time, stated to his other allies, who he was there representing England, that if we do this, it's going to cause a dictator to come to power. It's going to cause instability, and we'll maybe be having to fight a second war. But to no avail. He wrote a book on that and became famous for it. Hitler read that book and realized that this was a man that knew what he was talking about and adopted his policy. Keynes was brought over to talk to Roosevelt, and Roosevelt, basically, he did have a lot of spending programs. He justified them as, you know, these people just needed this help. He never endorsed Keynesianism, okay? But he acted like a Keynesian, and but he always claimed it was because he felt that the government should do something to help these people, that's a function of government. And so he did it as a moral measure, supposedly. But in fact, in 1937, the economy seemed to be recovering, and so the employment was rising, and you know, profits were becoming shown, and so he felt so good about the recovery, which he thought was perhaps due to some of his efforts, that he agreed to allow his banker to, you know, and to agreed with his banker to shut down some of the programs, some of the spending that he's done to try to balance the budget. And he tried to balance the budget, and it didn't work because the economy shut down. And so we didn't really get out of the Depression until World War II, which we'll talk about in a minute. Okay, so 1929 we have the Great Depression. Like I said, it lasted until after the war, certainly, for employment. Full employment didn't arise. Well, it arose during the war. All the soldiers were given a job, right? They were fighting for the U.S. government. That was their job. And the wives at home were actually working in the factories, building the ships and planes and arms, needed the tanks, They were all being made in factories which were supplemented with a lot of women, because there weren't enough men to fill all the jobs that were needed to do all this. And the government was spending that money to build all these things. And that really put money in the hands of these women who couldn't spend it because there were limits on what you could spend. You know, you had a quota how much gasoline you could use. You had a quota of all this, so there were limits on how much you could spend during the war, because they said, well, we need the gasoline, we need the tires for that, so you can buy a certain amount. And so basically there was a lot of savings going on by those women at home. And also the men, their paychecks were largely being sent usually back home. They didn't have anything to spend it on out there in the battlefields. And so at the end of the war, we had huge amounts of money built up. And unlike many conservatives who predicted that we would return to our stagnation because of all this debt that we built up, we actually took off, and we took on more debt when we lended money to Marshall. So the spending of the soldiers and their wives at home, and the spending of the conquered, or the European nations who had to rebuild, that included Britain, which was bombed a lot, and Italy and France and Germany especially. Germany and Britain were the two that were really bombed a lot. And so we lent money under the Marshall Plan to these countries in order to have them restored as democracies. So we wanted them to be restored as democracies and be allies. So because we thought that we needed them to deal with the threat of communism. So that's why we did it. But the economic effect was that there was huge demand here at home, domestic demand for consumer goods and homes. These soldiers were buying homes, they and their wives were buying homes, so there was a lot of building going on. All this demand was pent up from that, but also there was demand for our manufacturers for overseas. So, you know, to rebuild, they needed things. They needed steel. They didn't have steel plants. They were building steel plants, but they didn't have them. So they were having to buy it from us largely, and so we were providing that to them. And that basically meant that our economy was booming because of the international trade, which was very open, and you know, so there were no tariffs. And so Europe was rebuilding, and it was using American investment products, that is, you know, machines and steel from America were basically being used to rebuild the European factories. Steady growth in GDP and stable. 1945 to 1973, no major recessions. Yes, we had recessions, but they were nothing major. Single-digit interest rates, steady growth in GDP, and stable employment. So this was a golden age in some ways, you know. So this was not just simply a matter of luck. It was largely because we had actually done the right things in allowing for the spending and creating all this demand. And we became a leader and a marvel to the world. So anyway, in 1973-74 there was the oil crisis, and this caused a glitch, and we had a recession. I don't think it was all that major, but you know, it was clearly connected to the oil crisis, and so oil became an issue. In 1987 we had Black Monday. 1989, so in 1987 Black Monday happened, and the stock market crashed somewhat, not as deeply as it did in 1929, not as steeply as it did later in 2008, but it did crash in 1987. You know, and so there was a man named John Kenneth Galbraith. He was one of the talking heads which was always appearing on TV, and he wrote an article in Atlantic magazine in the spring of that year, 1987, and he predicted in that article that the economy was going to suffer and that there would be a decline in prices on the stock exchange. It was the only time he ever did that. And I heard that, and I was able to profit because I withdrew my stocks in my pension. I changed my position with my pension plan to becoming more of a bond holder. No, actually, I was holding money market funds. Because if I got into bond holding, I would have to, like, it'd be a while before I could get back into stocks, and I wanted to cut back into stocks relatively quickly. But I managed to get out of the stock market way before it crashed, maybe a couple of months before or a month before or something. And I waited, and sure enough, it crashed. And when it did, then I was able to buy the stocks at a low rate, and they quickly mounted up. So that was very helpful. But I don't count on doing that. And it was very strange. And I'd read all the man's books, and I thought he knew what he was talking about. It seemed to make sense. So if you're doing that, you're speculating. And generally speaking, it's, for most people, it's better to just buy and hold stocks. So after that, I bought and I bought those stocks and I held them, and until fairly recently, when I considered the fact that I'm getting close to retirement age, and therefore maybe I shouldn't be so risky in my investment portfolio. So I've maintained some stocks, but not major. Anyway, 1973-74 oil crises, 1987 Black Monday, 1989-91 savings and loan crises, which again had an effect on the stock market. 2001-2002 exposure of widespread falsification of earnings of major corporations like Enron, and so these major corporations had a major effect. So like 30% of the stocks being traded on the major exchanges were actually over-reporting their income sometimes, and had to rewrite their income. So they had to issue corrections, and so that was quite something. Because what Enron was doing, a lot of corporations were doing something similar to that, so there were actually, I think, over 30 corporations that were going into bankruptcy and were being, and shareholders were losing their money, basically, like Enron. And these were corporations that were largely investigated by the task force that was created of attorneys who would look into the management in these countries, and the financial officers and accountants who had cooked the books were basically charged, and the CEOs were charged, and so it led to the Sarbanes-Oxley Act, didn't it? And so that was the 2001-2002 exposure of widespread falsification of earnings, and there had to be, the piper had to be paid. 2007, the Great Recession. It starts in 2007 with the, I dated it starting with 2007, 2008. I guess the crash was more in 2008, but in 2007 you had the tumble. We saw the beginnings of the real estate crash. So 2007, 2008, Great Recession, exposure of widespread banking speculations by the major banks. Okay. Division of, now one of the things that they had done after the Great Depression, after the great stock market fall, after Roosevelt took office to deal with the Great Depression, they had done a number of things. And so one of the things they did was to divide banking into two kinds of banks. They said, well, there are some banks that are depository banks, we talked about that, also called commercial banks. They lend to consumers and small businesses, and they don't generally take too many risks. However, that's wise for them to do, because they have all these simple people's, ordinary people's monies to deal with, and these ordinary people expect their monies to be safe, and they're usually just getting a small rate of return. So they ought to be able to run the bank successfully and make a profit without dealing with risky business ventures and investing in risky business ventures. And so we're going to allow certain banks to be investment banks, and those banks will deal with the investments, and so they'll be the ones that you will go to for a startup, where a new stock is being issued. So they'll be the ones that a company will go to in order to issue stock, and they will arrange for that. And because dealing in these stocks would be more risky, these banks the depository bank would not be able to participate in these investment opportunities. And so the New Deal set up this division of banking. After the banking scandals and failures leading up to the Great Depression, Congress divided depository banks, labeling these banks, some depository banks, and the other ones were investment banks. So it divided the banks between depository banks and investment banks. Investment banks would take, the commercial banks would take the deposits from savers and others who want liquidity and safety. Investment banks would take deposits only from existing investors who were willing to risk more. And so basically they would be making more, and these risky investors would actually be buying risky securities. So they would handle these corporations that were issuing these new issues of stock and old, and they would handle that. So deposit banks, they accept deposits to checking and savings accounts. Now, why did they separate the banking? Because they thought that it had, a lot of the commercial banks, they decided it would be depository banks, had invested, a lot of small banks had invested in the stock market and got burned. And so they decided that they should not be doing that. And so they had done that. That was removed in 1997. That division between these banks was removed, and some people listed it as a cause of the crash of 2007, 2008. Also, when they were considering the Dodd-Frank Act, Volcker wanted them to put back the division, and they did that somewhat, but they didn't do it fully. And later they actually even diminished it less. And so it's been largely modified, so it never got back to be what it is, and so that causes some people to think that we still have problems. Anyway, deposit banks. Deposit banks will accept deposits and checking and savings accounts. These deposits would be covered by the Federal Deposit Insurance Corporation. Roosevelt had created Federal Deposit Insurance back when he first took office by executive order. But he immediately, after issuing that order, began to petition Congress and get Congress and pushing Congress to pass the FDIC as a permanent feature of our economy. And it worked wonderfully because it ended the bank panic that was going on at that time. So the bank situation stabilized. The bank runs ended because people were assured that they could. He went on the air, on the radio, and told people that they didn't worry. Their deposits are insured with the federal government, and they will get their money. And so that's what we've been doing. And so we don't see bank runs like they did prior to the creation of the FDIC, which is why nobody talks about getting rid of the FDIC, although that was one regulatory body created by the government, and at the time it was very controversial, but it's now well accepted that it's a good thing. So deposits covered by the FDIC, required to keep reserves at specified level. That's one of the things. If you took the FDIC insurance for depositors. You had to be a depository bank. You couldn't say we want to be an investment bank and get into investment banking. You couldn't do both, so you did one or the other. Required to keep reserves at specified levels. Must keep records for government inspection. Lend money to consumers and small business. Okay. Restrictions on methods in foreclosure. So there were restrictions, procedures. So the foreclosures couldn't take place real fast. There had to be some procedures that had to be followed. These were federal procedures. So how was the government able to do that? Well, it was able to do that on the Commerce Clause, you recall. The Commerce Clause gives the government power to affect things that are causing things to affect the nation beyond state borders, and this was certainly one of those. Lend money to consumers and small businesses. Debts dischargeable in bankruptcy were also restricted, and so there was a change in the bankruptcy law. Lend money to individuals and couples to buy homes through amortized mortgage. So in order to stimulate demand, we provided insurance for people. So, so there are various insurance programs that guarantee the banks that if they lend money to these consumers and these consumers qualify to get the kind of loan that they're applying for, it'll be insured by the federal government. And that keeps the rates lower, so housing becomes more affordable for ordinary people. The banks, on the other hand, must keep high percentage of the loans. So under the New Deal rules, they were required to not sell their loans to other banks or other corporations. They had to keep those, meaning that they had a real interest in only making loans that were going to be repaid. So, they were going to be inspected by the government, they were going to be audited by the government, but the government also just didn't want them to get into a situation where they could not do that, where they would be maybe, where the consumers would be maybe have their banks not able to keep that the bank would not become broke because of having sold or holding loans that were not very well sound investments. So this is all done during the New Deal. Bankruptcy may either discharge debt or allow reaffirmation. So with a home, if you make a mortgage on your home, you can usually reaffirm the debt by promising to pay the cost of the mortgage, paying the mortgage off over time, paying the premiums that you're required to pay. And that's all you need to do. You can usually reaffirm in a bankruptcy. So you can say, yes, I'm going to pay this debt. And it's not discharged. Other debts will be discharged, and the people who lent you money for, say, buying a car or a radio or a computer or whatever you borrowed money to, a boat, they stand to lose their money in discharge, but you can reaffirm your debt if you actually bought real estate in order to live in a house or on a farm. You can reaffirm that, meaning that you'll pay off the debt over time, just as you would have anyway. So restrictions on the methods of foreclosure are also part of what they were doing with the New Deal. Investment banks. Except for certain disclosure requirements, these banks are not subject to a lot of government supervision or regulation. They're free to take on risky ventures and lending practices. They'll handle the initial public offerings. There are deposits made by investors, and those are not insured by the government. We're not insured by the government. So that was something only that depository banks would have. So there were deposits by investors. Usually these deposits were being invested by the investment bank. So an investor would give some money to the investor, and they would handle the money for him and invest it for him in various, either at his direction or in various stocks and bonds that they felt like that. So the investor still had control over it, but they actually were holding the money and executing the buy and sells. And when they executed a buy and sell, the investment banks were able to charge a fee. So that's why they did it. And they would, because it was in their interest, provide these investors with advice that also would be subject to supervision and regulation by the federal government. So 2007, 2008, well, actually in 2001, 2002, when the Enron scandals happened, there was a certain bank advisor who would advise investors and advise companies on their stocks, and he would hold these seminars and tell people about things, and he touted Enron a lot. And so he basically boosted Enron unreasonably and was held to account for that, and was kicked out of being an advisor, kicked out of his status as an SEC qualified advisor, qualified to give advice to these investors. So there is regulation of these investment banks, just a different kind of regulation. And so, yeah, he was actually disciplined, and that can happen if you are involved in major scandals. Keynes. Keynes, like I said, basically wrote the book on how to handle a depression like we were having in 1929, as the whole world was having this depression eventually. You know, and basically his message was that monetary policy was likely to be ineffective. Why? Because he said you couldn't lower the interest rate sometimes low enough. And fiscal stimulation is required. That was his basic message, is that the government, in this case it would be the Congress and the President, would have to spend money to get the economy moving again. And so it would require fiscal stimulation. He said that, you know, basically he wasn't at all sure that the Federal Reserve could have avoided the depression on its own, because things had just gotten so bad at that point. But, you know, that's because he was largely thinking that they couldn't have interest rates below zero, right? Well, Bernanke had an idea on that. Anyway, new Keynesian economics came along, and the Keynesian analysis usually assumes a variety of market failures. Keynesians assume imperfect competition in prices and wages, which is different than classical economics, which doesn't assume that. And both classical economics and Keynesians believe that people will act rationally and make their decisions rationally, but the Keynesians believe that their rationality doesn't do them any good when the market is acting wacky. So, you know, when there are market failures and when prices and wages get stuck, explains why prices and wages can become sticky, means that they don't adjust quickly to changes in the economy. So Keynesians would say that when you have a business downturn and people are being laid off, you can't necessarily just, you know, tell the people who are working for you, oh, well, we have to cut your prices. They will resist that, and, you know, they may strike, they may, you know, very strongly resist that, and so basically they still have their debts to pay, so they're going to resist that. And so this is one reason why these prices and wages become sticky. So the company can't really lower its prices too much because it doesn't want to cut the wages, and the workers are not willing to accept lower wages easily. So there will be resistance in some industries where you have unionization or just resistance period, you know. And prices tend to stay up and even go up sometimes. You would think that with a depression you oftentimes get deflation, which is actually not all that desirable either, because it leads to more and more people being unemployed. And so prices and wages being sticky means they won't adjust quickly to changes in the economy. which would realign the workforce, and maybe less people be working, and so the overall effect on the economy might be better. But it's, the classical solution, or thinking that the market will self-regulate itself, will correct itself, is largely a delusion. It takes a long time for the market to actually correct itself. Something else has to come in, like a war, and that brought us out of the Depression, certainly. Wage and price thickness and market failures prevent full employment, he said. So Keynesians argued for stabilization by government spending or the Fed lowering rates to stimulate market demand. Keynesians used a lot of mathematical formulas, which is something that wasn't used before by investors. Before, the investment advice was largely more what you would call rules of thumb. Sort of the wisdom of the ages. This is what you do, and here's how you manage your money. And and people did maybe look at what a company was making and look at statistics on what its sales were and whether it made profits. But it wasn't very sophisticated. There was no sophisticated analysis. Keynes was a mathematical genius. He was, I think he took a first in mathematics from Oxford, England. He took a second in economics, okay, but he took a first in mathematics. He said about economics that the people who were testing him for economics didn't know what they were doing. So anyway, so Keynes argued for stabilization by government spending. So the government would spend money to put hands in the money of workers, thereby increasing demand. What creates jobs? You think businessmen create jobs? They only create jobs if they see that there is demand for a product that they can make. Then they'll create a job. But a businessman is not going to create a job unless there is demand. And during a depression like we had at that time, where people were being laid off and demand is diminishing with each company that folds and goes bankrupt, demand diminishes because more and more people are out of work. And as more and more people are out of work, demand diminishes. So you have to put money into the hands. We see the same thing going on with COVID-19, right? Why is the government putting money in the hands of these people? Part of the reason that Trump justified his COVID program and the Congress justifies his demand for, again, more of a COVID thing, was to increase the demand and to keep the economy going. But in the end, there's got to be some other kind of thing rather than just simply giving money to keep open restaurants. There's no future in that. It's going to eventually be, if we have to continually keep them propped up, where's it going to lead us? Probably we do need to have something, as Biden suggested, that we start a program maybe to get rid of our dependence on oil. And I know that's going to affect the oil industries and the gasoline industries, but maybe it's something we have to do. And building those, just as during the Great Depression we built dams to create energy and electrify parts of the country that didn't have electricity readily available, just as the ideal of now building sustainable energy sources such as these windmills has its appeal and could create a lot of jobs. So I think that's what you're going to be seeing, is that we'll probably have some sort of program that is, provided we can come together as a country and agree to do it. And with the situation in the Senate where it's, I don't know, at this moment it's just evenly divided, but if we get gridlock in the Senate and we can't do any stimulus programs, then the economy may be in bad shape. And so people, I think investors are right now confident that this will all be worked out, and Biden certainly indicates that he's willing to work with the program, and so he has some ideals, and they deserve a fair shot, a chance of succeeding. Anyway, Casey argued for stabilizing government by government spending primarily, or by the Fed lowering interest rates to stimulate market demand. which in some situations obviously did work. It was exactly what Bernanke did to keep the economy afloat. But you do realize, well, I think I got another slide on that. Well, first off, I want to say, like I said before, World War II, at the end of the war, the soldiers returned home with money they and their wives had earned and saved during the war. They couldn't spend it because of the rationing program. And domestic demand was high, creating jobs and prosperity. I didn't add in here that there was also a lot of demand being created by European countries who were rebuilding their economies and rebuilding their plants, and therefore they needed machines, they needed equipment, they needed steel, they needed a lot of things that we could build for them so that they could replace that which had been destroyed during the war. So that's causes of the 2008 economic collapse: a do-nothing regulatory attitude by regulators. Basically, there's been a lot of work done on that, and I have a bunch of slides. I probably won't be showing them today. I'll probably be showing them in a future slide program, which I have, that talks about all the regulatory, the failures, to regulate, the failure to to maybe enact regulations when new regulations needed to be done, the failure of regulatory bodies and corporations, private corporations, which were part of the regulatory body, to actually curb the risky spending that was being done by the banks, and to curb the predatory banking that was done by some of the banks, which did great damage to the consumer economy and to certain consumers, obviously. So this is one of the causes, is a do-nothing attitude by regulators. They thought they seem to be following a classical economic scheme of allowing the economy to recover for itself. So it's the complete opposite of what they should be doing. Lending practices, that basically up until 2008 didn't do enough to stimulate the economy. The Fed's facilitating of a desperate borrowing, thus creating a synthetic and prosperity. So the Fed was facilitating a desperate borrowing by the businesses. Instead of looking at these businesses as to whether they were being run soundly and profitably, you had a lot of bad loans being made and junk bonds being sold, we allowed this to happen. Elevation of the financial sector over agriculture, commerce, and manufacturing. Okay, so these are seen as causes of the economic collapse. Bernanke's solution. Bernanke's solution was that the Fed would respond with extraordinary monetary measures to stimulate the investment. What do I mean by that? Well, he was using the Taylor rule, and it just so happens that the Taylor rule indicated a rate of interest for open market operations requiring interbank interest rates to be set to less than zero. So banks could borrow at less than zero. What were they going to do with this money? The idea is they should then make money available at a very low rate of interest. They can make money available to consumers, say 3, maybe 2%. If you're getting money at zero, you can lend it out at any amount, and you're just making money. And so there was some indication that to qualify for these loans, they had to pledge that they would actually be lending money out in order to, basically there are opportunities even in the worst of times for a business to get started. So a business might want to get started because it can see an opportunity to supply something that's now suddenly in demand that maybe wasn't in demand before, but that was before you have the economy slacking. So there are certain products that are counter-cyclical, that will be very much in demand during a business slump. Same is true if you have a depression. There will be certain products that become very much in demand. The little money that people have, they'll want to buy certain things, and suddenly these products are in demand, and so maybe you need to create businesses that supply these products. On the other hand, there are, if you lend money to restaurants, the trouble with the COVID-19 rescue plan is it's nice, and I don't begrudge the people who are getting that money anything to help save their business, but it doesn't really build much for the future. And also, there are going to be a certain number of customers who don't return to the restaurant, even if you allow them to. So there are certain people that will, most old people apparently are staying home, not going out. There's very low rates of infection for older people. The younger generations are actually more often getting the disease. However, if an older person gets it, it's generally fatal, or oftentimes fatal. Not always, but a high rate of deaths for those who get it. So that, I think, has got them not going out. And then there are other people who just simply, I know people who are not going out to eat like they might have at one time. For one thing, maybe some of them don't have the money. Another thing is that maybe they're worried about the exposure in these restaurants. And so, I don't know that the slump in the business wasn't continued anyway, largely because of people's choosing not to be exposed to it. So Bernanke's solution, he used the Taylor rule to its fullest, and he said, okay, it indicates I should indicate zero. And he knew that the Congress was reluctant to enact a strong stimulus plan. There was some stimulus plan, but every indication is that the stimulus plans were like Roosevelt's stimulus plans. They weren't maybe strong enough to get it out. They were more like his plan when he was trying to balance the budget. He had some stimulus programs going on, but not enough to keep the economy growing, or to get the economy growing full time. And so it was a concern with deficits, frankly, that caused them to be reluctant to do that. Bernanke, on the other hand, outraged a lot of conservatives who had previously supported him by adopting such a liberal lending plan to allow banks, and got criticized not only by liberals but by some people who were not liberals, but who basically thought the banks shouldn't be getting this kind of really great opportunity to make money. Well, if they're making the loans, they can help us, and so I don't begrudge them that myself. Anyway, that's it for now. I will be talking on the next lecture on I will be talking on the solution or the problems of the 2007, on the current problem of our COVID situation with our economy, and and so we'll talk about the actual changes in the regulatory scheme brought about by the 2007 and 2008 crash, which we haven't talked about fully enough, but we'll do that next time. Thank you very much for today, and take care, and okay, see you next time.